Hi, I'm Patu from FreeFinCal, and in this video I want to talk about the yield curve, the bond yield curve, and why everybody is worried that it is inverted, and why everybody is talking about recession and worrying about their job and what will happen to the stock market. So instead of worrying about all this, I think one should focus on managing their finances better, use this as a warning sign for their finances, and put their fiscal matters in order. So, to understand why people are worried, we need to understand what the bond yield is. The bond yield is defined as the interest offered by a bond divided by its current market price. So, usually, the bond yield and the price are inversely related. So, when the demand is more, the price of the bond is higher, and then the yield becomes lower. So, typically speaking, so bond yield of short-term bonds, let's say 1 year old bond, 1 year duration bond will be typically lower than 10-year bonds. The reason being that normal circumstances, people will not want to commit their money to or lock in their money to long-term bonds because they believe that they can get higher return from elsewhere, from typically, let's say, equity or investing in private businesses and so on, something like that, some other investment opportunities. So if you were to plot the bond yield and all the durations, that is 1 day, 10 day, 1 week, 2 weeks, 3 weeks, 1 year, 2 year, 30 years, 40 years, 50 years, all the increasing duration on the horizontal axis and the bond yield in the vertical axis, you call what is known as the yield curve. And the normal shape of the yield curve is like this. The higher duration bonds have got a higher yield, and the lower duration bonds have got a lower yield. That's the general normal curve. That means that the demand for the low duration bonds is higher, and like I just said, and people don't want to lock in their money to into longer duration. During certain circumstances, for example, we had this in July 2013. I had written an article about this. When the rupee was getting devalued day by day, suddenly RBI increased the interest rate of the short-term bonds. Then the yield curve got, the shape of the yield curve got changed, and people are now worried because the shape of the US bond market yield curve has changed, and it is changed from normal, and over the last few months it's kind of gotten flat where all the bonds are typically the same, and it is now over the last few months it's got inverted. That is, the long-term bond yield is lower than the short-term bond yield. This means that even though people will lose out by locking their money on in a long-term bond, even though the coupon rate of a short-term bond is higher, they prefer to lock their money in a long-term bond because they are worried about the prospects of the stock market. They are worried that they will not be able to get better return elsewhere, because there are many multiple reasons for that. One is, the main reason is the US-China trade wars and so on. The stock market is shaky. They are worried about it. Because of that, the people are preferring to lock in their money to long-term bonds and not preferring the short-term bonds. So that is the inversion, and that kind of event in the US context. In the Indian context, this has happened many times before, and it's not related to recession directly. It's very difficult to do that, because last time it happened, it was in July 2000, around 2013 end or so. I think that, I don't remember. Yes, I think that's what I wrote about. But in the US market, they have found a reasonable correlation between the inversion of the yield curve, that is, from this normal curve to this inverted curve. This inversion is you typically followed by a recession. However, the recession can start few months after the inversion, few years after the inversion. So there's nothing to hit a panic button and worry about everything. So this is the article I linked today in today's post, the Washington Post article, and this is the yield curve, the current yield curve, and how it has changed since December 2016. And you can see that the yield curve in December 2016, it was kind of more or less kind of normalish, and then it is like that, and then it's inverted like that. So that's the inversion that people talked about. But this inversion has not just happened last Wednesday. It has happened. It's been happening over the last few months, and Again, from the same article, you can see in the past the recessions and the bond curve yield curve inversions. The inversions are shown in the circles, and the recessions are shown in the gray rectangles here. So every time there is a inversion, typically there is a recession, but the recession is not immediate. It can happen months and months and months away. So you cannot immediately assume something's going to happen. But at least, at the very least, all is not well. Investors are preferring to buy long-term bonds, lock in their money in long-term bonds, and not preferring cash. They believe that it's better for their money to be invested in long-term bonds than in the stock market. That is the reason why the curve has inverted, and that is the reason why people are scared. So you don't need to do anything for your long-term goals. Don't, if you're investing in equity for your long-term goals several years away, don't worry about it. But several years means at least 10 years away. Don't worry about it. But there are things that you need to do, especially if your job is not permanent, and if the revenue of your company depends on the US market or any other international market. Then you have to worry about it and make sure your financial position is in order, and that's what we want to talk about here. So if you lose your job, how long can you live off your investments without factoring in the severance pay? Don't worry about the severance package, whatever it is, let it be. Can you live off your net worth for at least 1 year? So you must have in a simple SB account or FD account or a fixed deposit of a trusted bank, money equivalent to, or maybe post office, money equivalent to 6 to 12 months of living expenses, including insurance premiums, including EMIs. That much money should be mandatorily kept away. That is when you are safe even if you lose your job. Do I have the skill set to be re-employed within a few months? If you do not have that, then you need to find out if you can do something about it. And if you think you will not be re-employed if you are in such a situation, such an industry, then the emergency fund should be probably larger. Now, can you freelance and do something on your own? Please work on it. Please try and build a secondary stream of income. I've made a series of videos on it. I have an article on it. I'll link it. Please work on those and try and get yourself start a secondary source of income. It will help you. If the market crashes, will your if there is a recession, will your short-term goals, that is any goal for which you need money between 5 to 7 years, will it be affected? If the answer is yes, then immediately pull out all the money from the stock market. Anyway, you should do it. Whether it is the yield curve is inverted or not, you should do this. So it's the generic advice. Pull out all the money from the stock market and put it in safe investments. Don't put it in debt funds. Oops, that's the power. Don't put it in debt funds. I meant not just debt instruments. Debt mutual funds, they are not typically safe. Debt mutual funds are not particularly safe because they're market linked, and if there's a huge crash or anything, there can be a problem in the debt fund as well. So please be careful where you put it. Put it in proper safe fixed deposits or post office schemes, wherever. Then you're guaranteed of it. This is for short-term goals. Do you have a separate health cover? See, when you are in general, when you leave a company, you can always transfer your group cover to an individual cover, but can you do that when there's a mass layoff? So I don't think you can. So I'd suggest you recommend that you get a separate health cover. Better for you to do that. Get yourself life insurance if you don't have one. So all these things, if you handle, you can make yourself recession proof to a certain extent. Download this ebook from my website. Do follow it step by step. You can take one action every week and continue doing that, and you will be able to completely fortify your family against such events, whether it is recession or any other kind of unexpected event that can affect your cash flow. So please work on these, and if you have any questions, let me know. Thank you as always for watching.